So you buy a stock, and suddenly you're a part owner of a company. Sounds simple, right? Well, it turns out it's not that simple at all. In the same company, you can have two completely different kinds of owners, each playing by a totally different set of rules. We're going to break it all down. Think about it. When you own that share, what do you really own? Are you in the driver's seat, helping to steer the company? Or are you more like a first-class passenger, guaranteed a comfortable ride but with no say in the destination? It's a huge difference, and one that most investors never even think about. Yep, that's right. This isn't just some boring technical detail. The type of stock you hold could be the difference between making a fortune and walking away with absolutely nothing. It really is a tale of two owners, each with a very different story to tell. Okay, so in our first section, let's meet these two characters. Imagine one company, but two very distinct types of owners walking its halls. So on one side, you've got the power player. This is your classic common stockholder. They are all about having a voice, having control, and chasing that explosive growth. And on the other side, we've got the priority pass holder. This is the preferred stockholder. They're not looking for power, they want safety, security, and a predictable return. And the relationship between these two is all defined by something called the capital stack. Just think of it as the company's financial food chain. At the very top, you have the lenders, the banks and bondholders. In the middle, right below them, are our priority pass holders. And way down at the bottom, holding everything up, that's where you find the power players. And trust me, this pecking order is absolutely everything. All right, let's get into the nitty-gritty. What does this trade-off between power and priority actually look like? What do these owners really get for their money? So, the power player, our common stockholder, gets to vote. I mean, they elect the board of directors, they weigh in on huge decisions, they literally have a say in where the company is headed. And the best part? If the company becomes a massive success, their potential profit is unlimited. Sky's the limit. But what's the catch? The catch is being at the very bottom of that capital stack. They carry all the risk. And this brings us to a really critical concept: residual claim. It sounds fancy, but it just means common stockholders get paid last. They get whatever is left over. Imagine the company's value is one big pot of money. First, all the lenders and creditors get paid. Then, our priority pass holders get their share. The power players, they only get what's left at the bottom. Sometimes that's a feast, but a lot of the time it's just crumbs, or nothing at all. Now let's look at the priority pass holder. They basically trade their voting rights for security. Their big prize is a fixed, predictable dividend payment. It's kind of like earning interest on a bond. The company has to pay them their dividend before the common stockholders get anything. But that safety comes at a price. Their potential for huge gains is usually capped. In this table just lays it all out so clearly. You can see that fundamental trade-off right there. Common stock gives you a shot at massive gains and a seat at the table, but you're dead last in line if things go bad. Preferred stock gives you that safety net and a steady paycheck, but you give up your voice and the potential for that explosive upside. It's the classic story of risk versus reward. Okay, I know this can all feel a bit theoretical, but there's one moment, one single event where these differences become painfully, brutally real. And that's when a company is sold or worse, goes bankrupt. This right here is the moment of truth. When the cash from a sale or a bankruptcy finally comes in, who gets paid? And in what order? This is where that capital stack we talked about stops being a diagram and becomes a legally binding set of instructions for who gets the money. And the payout order is completely rigid. There's no negotiation. First, every single lender gets paid back what they're owed. If there's any money left after that, the priority pass holders, the preferred shareholders, get their investment back. And only then, if there is anything left in the pot, do the power players, the common shareholders, get to split whatever scraps remain. So here's the key takeaway. Being a common stockholder means you are the ultimate risk bearer. You are gambling on a home run, because in a lot of cases, especially with smaller companies, the money just runs out before it ever gets to step 3. The power player's investment can, and very often does, go straight to zero. All right, now let's take everything we've learned and apply it to a really unique, high-stakes game, the world of startups and venture capital. Because in this world, preferred stock isn't just an option, it's the only game in town for investors. So venture capitalists, or VCs, are putting money into brand new, incredibly risky companies. To protect themselves from the super high failure rate, they almost never buy common stock like you or I might. Nope, They use a special, souped-up version of preferred stock that's packed with protective features. The founders and the employees, they get common stock. The investors, they get the priority pass. And the most powerful feature of all is called the liquidation preference. This is a game changer. It's a contractual guarantee that says when the company gets sold, the VC investors get all their money back first, sometimes even 2 or 3 times their money back, before the founders and employees who actually built the company see a single penny. And believe it or not, it can get even better for the investors. This preference can create something that investors absolutely love, a feature sometimes called double dipping. Here's how that works. If an investor has participating preferred stock, they get to double dip. First, they take their original investment off the top. Then, they also get to take their ownership percentage of whatever money is left over alongside the common stockholders. But with non-participating preferred, they have to make a choice. Either take your guaranteed money back or convert your shares to common stock and share in the risk and reward with everyone else. That one little word, participating, can mean millions of dollars. And finally, there's one more feature that makes preferred stock so powerful. It's often convertible. This gives the priority pass holder the right, at any time, to swap their safe preferred shares for those risky, high-upside common shares. It's really the best of both worlds. You get downside protection, but if the company suddenly takes off like a rocket, you can convert your shares and ride that wave all the way up, just like a power player. So after exploring these two very different philosophies of ownership, it all comes down to a really personal question. What kind of owner are you? So let's just recap one last time. You've got the power player, who's all about growth and control. They take the biggest risk for a shot at the biggest reward. Then you have the priority pass holder. Their goal is safety and income. They're willing to give up that moonshot potential in exchange for protecting their capital. And that leaves the final question for you. When you look at these trade-offs, power versus priority, risk versus reward, which path makes more sense for you? Are you the high-risk power player chasing that unlimited growth, or are you the security-focused priority pass holder? The answer says a lot about your investor DNA.